It's, it is now 6 p.m. Mountain Time, the center of the universe. It's also 8 p.m. Eastern, 5
Nice,
p.m.
John. Very nice.
And with that, let's get going. I think people will probably continue to trickle in. We had about, I believe, 80 registrants. So inevitably, a couple of people will catch the recording. But I'm glad we could put this together. It is July 26th, and our second REM Capital Educational Series, monthly webinar Q&A that we like to do. I think Robert called it more of a town hall format, so we could get live and see each other's faces and ask questions. So really, it's just kind of coming from a place of wanting to have good, thoughtful discussion, get folks to engage, ask questions that's top of their mind right now, and go from there. So, introductions. We've got Robert Ritzenthaler. He is CEO and president of REM Capital. Most of you know him, but if you do not, he is the rainmaker. He's the guy that makes all the things work, and he's also a big reason why I'm on the team. A lot of respect for Robert and what he does. Robert, how are you doing?
My goal is to keep it real and keep everybody slightly scared. Just kidding.
Sure. And Adam Beckstead, partner and vice president of acquisitions. He's the guy that makes me sweat at night when he pings me, letting me know that we've been awarded another deal. Sure. And we charge forward with confidence. But how are you doing, Adam? Oh, muted.
That was beautiful. Beautiful.
We had this problem earlier today with technology with Adam.
Sometimes it doesn't work up there in Indiana. They have to flip the switch.
That's right. That's right.
Let's try now.
There you go.
There we go. Yay.
Hey. Late night DJ voice indeed.
Yeah. No, thank you, John. I appreciate it. And I will say there's a little part of me that takes joy in making you sweat.
Very good. Very good. Well, with that, Robert, why don't you start off for the folks that are maybe a little bit less familiar with REM Capital, give a background on the organization, and then we can talk about where we are today and territories, employee count, etc.
Sure. So where are we well, let's back up, I guess, for some people that are probably new on the webinar tonight. So REM is about 5 years old, I think 4.5-ish, 5, something like that. We started the company with the idea that there was there was definitely an opportunity for a little more institutional approach to multifamily investing. Been a lot of folks that have entered this space over the last 10 years since the Jobs Act of 2012 was passed, which really opened up the world of syndication, not just in real estate, but across the board. So, it's been kind of in transition, and felt like there was an opportunity to bring a little bit more of an institutional approach to the individual investor in multifamily space. So that was kind of the genesis. And there were two things that we set out to do. One is find the right deal, and number two is find the right people. And that's really been the story from day one, still is today. We can find a great deal, but if we don't have the right people, it really doesn't matter. And you could actually take the right people and probably actually make money at the wrong deal, if I had to be totally honest. But obviously we want to find the right deal and the right people so that we can maximize our ROI. So with that being said, we are 4.5 years later. We've got, I think, 23 properties in the portfolio, about 350-ish million in assets under management, and about 85, maybe 90 people on the payroll. We're vertically integrated, so we do our own property management. We are developing a construction renovation arm as well, and just feel very strongly about being able to control the business plan from start to finish. And really outside of that, the goal is don't risk the capital and get a decent return. So that's kind of the gist of who we are and where we're at today. seeing some pretty good performance out there. Rent growth is strong. Any of you guys who are in the space know that, or if you have properties, you know that you read the news too. I mean, that's what's going on. So business fundamentals are good right now. Interest rates, obviously a little bit of uncertainty about that, which we'll talk about tonight, I'm sure. But that's kind of the gist of it. And actually, John, you did some homework today on our overall DSCR in the portfolio. We're just under a 2.20 on the DSCR. For those of you who may not know, DSCR is debt service coverage ratio. So basically, it's the fudge factor that we have over and above our debt service. So we essentially are generating twice the income that we need in order to service our debt on an average across the entire portfolio. Great place to be when you are in or potentially going into a recession or a challenging economic environment. And again, that's purposeful. We wanted to make sure that we've got that fudge factor. So yeah, I'll kick it back to you in case I missed anything.
No, great points there too. And I was also looking at year-to-date cash flow distributions to our partners. We're over $3.5 million year-to-date, which is exciting to see that go out every 15th of the month and continue to increase. And what else? Let's talk about what's going on currently, Adam, with REM Capital, what deals we have available, and what's going on in that space right now for folks that don't know.
Absolutely. So people that have not been following along, we just closed on Avenue 33 in Stockbridge, Georgia. Beautiful property. I'm trying to remember what date we closed on that. Tuesday?
Last Tuesday.
Last Tuesday.
Yep.
Yeah, so a week ago. Coming up next is San Antonio, Bel Air Marbach.
Adam,
Park.
you didn't mention that if anybody wants to buy it from us for $5 million more than we paid, we'll consider an offer.
Oh, well, that was a given.
Just kidding. Sorry, go ahead.
Great property just down the road from our development. Kickoff that we kicked off. I'm trying to remember when we kicked that off.
Wednesday.
About a month ago.
Oh, kicked it off for investment opportunity. It's open as of Wednesday.
Yes, Marbach Park.
Yep.
Beautiful property, 304 units. 16 of them going to be brand new when we take over, which is really exciting. Very high growth area, and really excited about this one.
Yeah, absolutely. Thank you. And something I want to mention about Avenue 33, we still have a little bit of space left in that opportunity as well. So if you're looking for any opportunities in Georgia, that is an excellent asset. We already own it. And I believe that we're already reaching our year 2, year 3 rents before we've even touched renovations. So pretty strong property. We're pretty excited about that one. Lastly, Robert, I saw that your CEO update went out. Something that stuck out to me was you mentioned that all of our properties that we've held for 2 years or more are hitting their preferred rate of return.
Yes, that was kind of cool. And I don't want to say expected, but obviously that's what we want to do is
That's what we should be doing.
We should be doing. Absolutely. Yep.
Yeah.
Hit that 24-month, outside 36-month target on the renovation improvement plan, and we should be past that preferred rate of return threshold at that point. And some of them quite a bit more. But yes, that was kind of cool to see. Even amidst the challenges that we have with finding people to come to work, just like everybody else is having right now, trying to get the right people in the right seats and all that kind of good stuff. Properties are performing and things are moving in the right direction. So, yep, pretty cool.
Absolutely. All right, great. So folks, we had a ton of great questions that came in. What's happening in the news right now? Of course, we have the Fed speaking today and tomorrow, the 26th and 27th of the month. I think that it's pretty much set in stone that we're going to see at least 3/4 of a point rate increase. Some people believe that's even going to be a point. So we'll stand by to see that. And a lot of folks are asking, how is that going to be affecting what we're doing and with multifamily real estate and the overall economy, of course, too. So that's going to be an interesting one. I was just at a investor lunch with a friend of mine. I actually learned to swim in his mom's pool growing up, and I was speaking to him about what's happening in the refi and the purchase business arenas for residential real estate. And JJ told me that refi is pretty much all but gone, as you would expect, and
Yep.
purchase business has certainly slowed down too. So certainly we need to be monitoring that space. But I think that we'll get into it a little bit later. But what does that mean for residential real estate values, and how does that actually correlate or influence what we do with multifamily investing, which I think that there's some important points there. Price reductions. I don't know if you've been watching the news, but Redfin just came out and said 61.5% of Boise listings have had price reductions. And that, for folks that don't know, I'm based in Boise, so certainly some shifting markets, which 12 months ago people were clamoring for price reductions because we had about 3 days worth of inventory in single family space. But anyway, so on that note, Adam, Robert, let's talk about the concept for buying for appreciation versus buying cash flow, because I think that there's some big differences with how I always say real estate is a multi-sided cube, and there's more than one ways to make money. What we do is very specific in multifamily housing. We're very targeted approach. But right now, if you are a fix and flip kind of a guy, and that's your business plan, or you're doing the BRRRR method, which is buy, renovate, refinance, or rent and refinance, excuse me, that they probably want to be very, very cognizant of what's happening right now, because those business plans don't really work out for you. But buying for appreciation versus buying cash flow, our business model is more looking towards that 5 to 7, 10-year mark of owning a property. And a couple of questions that we'll get into are around that. Well, what happens in this kind of a market? What happens when values are down, et cetera? So we're going to jump right into that. So let's go into the first question. Selfishly, I picked my dad's question. This is the first time that he's engaged with us. And my dad, Glenn, he said, it seems that real estate prices in general have peaked. How is this going to affect multifamily project values? Robert, you want to take a stab at that?
So the question back is, they've peaked for how long and how far are they going to go down? Because isn't that really what we're talking about at the end of the day? Does anybody think that they've peaked forever? I would wager a lot of money that not a single person would say that. So the question is, how long are they going to stay below their highs, and how far are they going to fall? And that's really where you begin to see the difference between looking at this as a financial transaction and looking at it as a business. And I like to think back to what Warren Buffett said years ago, where he equated buying a stock, just going out and trying to time the market and buy the stock, versus buying a business. And in his early career, he bought stocks and sold stocks. And he makes the very clear distinction when he started studying Ben Graham about understanding that if you really want to make money, long-term sustainable money in investing, you've got to look at the business that you're buying and focus on that. So we take the same approach. Multifamily is a financial asset. It is a real estate asset, but it is also an operating business. And we look at it as a business, and we value it as a business. Appreciation comes along with it because the business is more profitable. And that brings me to my final point, which is, how is the business of multifamily looking right now? Well, we have to ask ourselves, what drives that business? Well, multifamily is driven by jobs. We have to have people that are making enough money that can afford to pay the rent at our properties. We can go into a whole nother conversation about affordability, but in general, we have to have people that are making enough money that can pay for the rent. So what do we see today? A record low unemployment. Nobody can find enough people to work. Everybody's got a job that wants a job, and the people that do have a job are making more and more money. In fact, we just hired somebody that probably got about a 40% increase in what they were making previously, because the job market's tight. You need good people. You got to do what you got to do. So I know that doesn't answer the question of the timing per se, but I always go back to the underlying fundamentals of the business to say, how are we doing today? Are we making more money than we were a month ago, than a year ago? Now, people would make the argument, yeah, but you're going to pay more in interest, potentially. But you have to think about this. If you're paying more in interest today, you're probably paying a lower purchase price, just like we did on San Antonio. We're probably paying about 15% less than what we paid a year ago. If interest rates stay high for 3 years, which again, I think is a stretch, let's just stay high for 3 years. Maybe we'll spend $1.5 million in additional interest costs. We saved $5 million. That's a worst case scenario. If you do the math, that's about a 350% return on your investment over that same time period. Now, if interest rates only go up for a year and that causes us a $500,000 increase, then we've got a 10-to-1 investment return on that decrease in our purchase price. So again, I think it's important to look at it in the big picture. Now, again, that assumes that people have jobs, they can pay their rent, rents continue to go up, but that's what we're seeing today. So I would argue that while real estate prices may not be going back to their highs for 6 months, 12 months, whatever it is, that really doesn't matter at the end of the day. If we're owning this asset as a business, as a long-term profit generating business, we are going to be generating more profits. So, well, how do we want to put ourselves? We want to put ourselves in a position to hang on to that good quality asset until the market comes back. And again, same exact philosophy that Warren Buffett uses. He says, buy quality and hang on to it. The idea being, if you've got quality, you're not going to have to sell when it's down, and it's always going to come back. And real estate always comes back. So I don't want to not answer the question, but I also don't want to predict something that nobody knows. Nobody knows what's going to happen in the real estate market. So we focus on the fundamentals, keep our eye on the ball, make sure we're profitable. And it almost doesn't matter what happens market timing wise, if you will, because we're always going to make profit. So
yeah, I think that, short term, the crystal ball is pretty hazy. And, if you're buying for appreciation, then, that can be a problem for you. But if you're buying for longer term cash flow, our properties cash flow from day one, unless it's a new construction scenario, obviously, the price of the value of the property could go down by 50% the day after we close on the property. Ideally, that wouldn't happen, but nonetheless, it doesn't really matter as long as we're still, holding on to the asset, we're cash flowing, we're managing it at a high level and executing on the business plan. So anyway, Glenn, thank you for that question. I appreciate that. And that goes directly into Chris's next question. Supply chain and inflation on the San Antonio Lake Vista development project. Robert, what kind of thoughts do you have on that? I know that we had talked about that in the webinar for that project, but
yeah. Well, so we actually kind of delayed the kickoff a little bit with the assumption that lumber prices were going to drop, supply chain was going to get better. And again, this was kind of mid last year when we had some of these conversations. That's exactly what's happened. So we are now in a situation where our lumber prices have come down 60% from, call it the worst case scenario, and they're still coming down. Now, some other things have gone up, concrete, steel, things of that nature have gone up. But we've also seen supply chain issues start to ease up. So right now, we're actually in a much better position than when we initially started putting the deal together from that perspective. Now, on the flip side, interest costs are a little bit higher, but we've got a cap on it, so it's not like we're exposed completely. But from a business standpoint, we're actually in a much better position there. And I'm actually excited because the economics of the deal overall have gotten better because rental rates have gone up significantly over the last year. San Antonio, if I remember correctly, is somewhere in the 15–20% range in 2022 alone already. So if you think about that from a new development project, we're able to lock in pricing essentially at today's rate. By the time we start leasing, we're 10% higher. We haven't done a thing. And in our case, some of our pricing was based on higher numbers a year ago when we were thinking that we may be still faced with this COVID supply chain issue. So, and lumber prices were a lot higher too. So we've actually been able to save on the lumber, see the rents go up. So my anticipation is, unless the rental market falls apart, which I don't see happening because jobs are still really good, we should be in better position than we were when we initially kicked the deal off. So,
And we're playing some defense there too, Robert, if I remember from your comments
yes,
about
we are.
staging in the thirds now too.
Yes, you're absolutely correct. We definitely did that as well as a defensive strategy, which we'll probably always do on our development deals, just because that's kind of our DNA.
Sure, very good. Adam, let's take Julian's question on how are you adjusting your underwriting assumptions moving forward, and that kind of follows into Irvin's question, which is, does the current economic environment affect how you structure your deals? So on your acquisition side of things, Adam, what are you doing right now with those in mind?
Yeah, so I would say that every deal is going to be unique within itself, and it always has been. So we have to kind of assess each and every deal individually. But I will say that a lot of the stuff that we're doing today is stuff that we've been doing from the very beginning, and being conservative in how we underwrite. Now, obviously, we're going to look for deals in the right markets. We want to be in markets that have a very high resilience to recessions. We want a good population with increasing population. We want good job market, as Robert had mentioned. So buying in the right market is going to be key. So there are some areas that we just won't look at, even though the deal looks good, the numbers look right. We're not going to look at a deal because it could be in the wrong market. Now, when you get into the deal itself, we're going to be looking at the exit cap rate, which really multifamily is driven by, is the percentage based off of the profit of this business, as Robert puts it, with the multifamily. So rather than being at a lower cap rate, or a cap rate similar to what we're going in at, we're actually assuming that our cap rate's going to be at a higher percentage, which would actually lower the price of that property being at a higher percentage. So we're being conservative there, and we're figuring, hey, these cap rates aren't going to be as low as they are today in, let's say, 5 years. Now, they may be, but we're being a little extra cautious and lowering that exit cap rate.
Mhm.
We're also, if we're calculating a refinance, which we are on our recent deals, we're actually underwriting for a lower loan to value on our refinance. So we're not saying, going in there saying, hey, we're going to get this huge 80% loan to value loan. Some of these we're going in and we're saying, hey, we're going to pull out 65% and see what that underwrites to. That's a very big key thing. And we're also buying and calculating into all of these rate caps for our loans, so that the loans that we are getting currently, if rates do continue to climb, we're actually buying and hedging insurance against those climbs to ensure that we're not going to continue to pay high and high and high. You know, we're actually going to hit an amount, essentially buying insurance for your loans.
Sure. Robert, anything to add there?
Well, I would say most of what we're doing in the underwriting is very similar to what we've always done. The other day, though, I did stress test 2 of our deals to 8.5% interest, and I haven't done that in a long time. They still stress tested, which is great, but I haven't had to stress test it, haven't even had the thought of doing that for quite a while. So that was new. That was a little bit different. Other than that, I would say most of the things that we're doing are the same. We've always had low leverage. We've always had working capital. We've always stress tested occupancy, those kind of things. But I haven't typically stress tested a very high interest rate on a refinance, because that's really the only time period where that could happen. We're fixed for 5 to 10 years on all of our loans. But when the 5 years comes up, where could that interest rate be? Now, do I think it's going to be at 8.5% in 5 years? Very, 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 very small likelihood. But you know what? That's what stress testing is all about, kind of a worst case scenario. So that's the only thing that I can think about off the top of my head that is a little bit different. Haven't done that in a while, but recently we've decided to do a little bit of pushing the envelope there just for double check.
Sure. And then for the folks that are on the call, I think the devil is certainly in the details for underwriting, because
Yep.
you can adjust just a couple of things in a model and make it look very, very different. And
Yep.
and we see that a lot with offering memorandums with different properties, or in the business. And I think that that's an important.
John, I'd love to tell a story. I'm obviously not going to say specifics here, but it's about 2 years ago. I was driving around the car looking at a deal. I don't remember where I was. Anyway, and somebody texted me and they said, "Oh my gosh, I got this phenomenal deal it just sent to me." It was an A-class deal in a top market and 25% IRR. And I thought, wow, we need to just shut down and go invest with these guys, because that is unbelievable. If you can do a 25% IRR on an A-class deal in 2020, let's do it. So I said, okay, you know what? Do you have any underwriting? Did you get any information on the deal? He said, yeah, sure. I'll send it over to us. Seriously, I'm just curious. Like, I want to know what we're doing wrong. And if they're hitting it, like, we're on board. Anyway, ran the underwriting. I came up with a 10% IRR on that exact same deal using my underwriting. So it helped me go from, sometimes you feel intimidated when you look around at your competition. You're like, man, I don't know how they're doing it. But it helps you kind of say, you know what, just stick to your guns, stick to what you're doing.
Mhm.
And it's okay to be conservative, and eventually people will figure it out. But anyway, so I always like to tell that story because it was kind of eye-opening for me as well, just to realize that just because you see something on paper doesn't necessarily mean that that's how it all goes together.
That's a good story. I'm glad you shared that. Okay, Chris Anderson, I see you're on the call. Thank you very much. Best geography within the U.S. for investing in multifamily real estate. Some people would argue that the best market is your backyard, because you know that market really, really well. Me personally, I do not own a thing in Boise, and that's because it's been a pretty strong market, and I haven't been able to make sense of a deal here versus, and I've had Robert look at over my shoulder before too, versus other markets like San Antonio, Charlotte, Atlanta, etc. So really, I think that you kind of have to geek out on demography and know where people are moving and why. And you can make an argument that the political scene for a given state, jobs friendly, business friendly environment, landlord friendly environment, makes a much better case when you're looking to be a for-profit business owner in owning an apartment complex. So those would things that I would first look at when I'm starting to narrow down what states do I want to be in, what metros, and then what submarkets within the metro, et cetera. On that note, I've had a couple of people just randomly send me deals on LoopNet, and I think that's the worst place to start, just randomly scrolling through LoopNet at deals, because you're kind of going backwards rather than starting with the right states, or the right geography and trickling down to exactly where you want to be. People are just sort of throwing a dart on the map and saying, "Oh, that's an interesting property. What's this about?" That's not going to be a recipe for success, in my opinion. But I don't know what you guys think.
Well, I was going to add to that only in the sense that I think the key question even before that is, are you buying for yourself? Meaning, do you want to own and operate your own property, or are you investing? Essentially investing meaning I'm picking a partner, an operating, group that is going to invest my money. Key questions there. If you're going to invest your own money, totally agree with John. Invest in your backyard. Invest in a place that invest for your vacation, invest somewhere where you grew up, that market. Super, super important if you're buying and operating that investment. Flip side, if you're looking to invest your money, the location almost doesn't matter. You want to focus on finding the right partners, the right group, the right the guy that has the experience to know how to pick the markets, to know how to pick the deals, to know how to manage them, to know how to turn them around. that's really what you're looking for. So it's a very different approach. You can sit there all day as an investor, kind of like with the stock market. You say, well, I'm going to analyze Coca-Cola's financials and I'm going to figure out blah, blah, blah. Let's be honest. You are never going to compete with an analyst or somebody that does this for a living analyzing those financials. And it's the same thing in multifamily. So if you're looking to invest, I really believe the focus should be get to know the guy or the team that is running that deal, running that company, find out who they are, find out their experience, find out if they're honest, find out if they're diligent, and the rest generally falls into place because there's a lot of good markets out there. And, we're not in all of those markets. We're in markets that we feel comfortable with because that's our job, to make sure that we know our market. So I just think it's important to nuance that a little bit to bring some clarification to folks that are looking at this from different angles and trying to figure out, where do I focus my time when it comes to the multifamily space?
Great point. Thanks, Robert. And that kind of does that pairs well with a question that we're going to answer out of order. But Zach, I think that you're on the call. You asked, how do you invest in out of state? Now, if you can come off mute, are you specific to single family? Or are you talking about how do you invest out of state for multifamily? Give us some context there.
I think it's a different Zach.
Might be a
Josh.
different Zach. Well then, Zach, never mind, because that's not your question. So we'll go from both angles. So
They're spelled differently.
yeah, that's a good point. I didn't even notice that. So how to invest in out of state? If you're investing and you plan to be an absentee owner of a single family property, you live and die by property management. And you really do need to take the time to fly somewhere and learn the market, get to know the operator that you're working with. There's people that do turnkey, properties around the United States, et cetera. There's a lot of different outfits, across the US. So once you have that, make sure that you understand, hey, what can I expect from you as a property manager? See if you can get some references, et cetera. Now, if you're going to be investing out of state as a limited partner in an apartment complex, I think going back to what Robert has already talked about with our previous question is know the operator, know their track record, know what they're doing, and get to know them very well, get confident with them, and maybe even talk to some current investors that they have. Those are all great opportunities to get more informed and confident with before you make an investment. So
Absolutely. Yep.
okay, Tim Saunders, thank you for the question. 1031 exchange from single family into multifamily. Robert, what do you think? Easy peasy.
Totally doable. Absolutely. Yeah, I don't want to say that it's easy, but it's definitely doable. I think the only caveat for us, and this doesn't apply to everybody, but for us would be sort of a lender issue as well as a practical issue, is that the dollar amount typically needs to be about $1 million to make economic sense. And the reason I say that is because the legal fees, the additional work that the lender has to do, it's usually about $40,000 to do a 1031 exchange. So normally, if you're coming in with 100 grand, you got to give up 40 to get your 1031. It doesn't make sense. There's also, especially recently, a little more scrutiny by lenders on the dollar value of a tenant in common that's coming into a deal. A tenant in common is essentially how you're owning that asset under a 1031. You are a true co-owner of that property. So a lender a lot of times will not like owners who have very small interest. They basically say, look, I want somebody on there that's got a significant interest. They're very vested in this property. Now, if you're buying $1 million property and you bring in 100,000, that's a different scenario. But if you're buying a $60 million property and you bring in 100,000, again, that's where some of the challenges come in. So I would say that if you have a single family home that is worth $400,000 and you've got 200,000 in equity that you want to roll into a 1031 type of a deal, find a smaller deal. Find a deal that's, a couple $1 million, it would probably work. Or find a deal that's done through a local bank. Local banks don't charge all the fees that these, Fannie, Freddie, agency, bridge lenders do, which finance the larger deals. Larger deals tend to cost more. It's just fact of nature. Those smaller banks are not that way. So there's a couple different options, definitely doable. I would say this though, make sure that you have an attorney and a CPA involved. Very critical that you check the box. There's a lot of requirements. There's actually 12 different steps that the IRS looks for, 12 different check marks, if you will, that the IRS looks for to ensure that you've done everything to qualify for a 1031 exchange. You don't want to mess that up, obviously, because of the potential tax liability that could come from not doing it correctly.
Yeah, great point. And then Brent had a question as a follow-up. Do REM investors benefit from a 1031 exchange when an asset is sold? You betcha.
Yes. Yeah, I mean, it's the same as any other investor, you bet. And you're able to then obviously take those proceeds, roll them to the next deal, pay no taxes on it, or I should say defer your taxes, because technically the taxes are still owed at some point, but you're deferring your taxes just like anybody else. And as a additional point to that, when somebody invests as a regular LP investor in our deals, we will 1031 those proceeds also as a group. So I have a lot of questions about that. People saying, oh, but if I invest as an LP, I guess I don't get the 1031 benefits. Well, you actually do, because we'll take that entire group with us to the next deal. As an example, we invested in a deal in Lexington, Kentucky about 3 years ago, sold it about 6 months ago. We sold it for about a 1.7 multiple, took those entire proceeds, rolled it into our Midwest deal, tax-free, and those folks are now getting 11, 12% cash on cash return from that initial investment. They've paid no taxes. They're not going to pay any taxes for another little while. And we plan to do that again in another, 3, 5, 7 years. So it's a pretty cool model. And again, there are a lot of nuances to getting it done right, but that is one thing that we definitely are big on.
Right. No, that's a great point. Great point. Okay. Dale, I don't think that you're on the call. Locating good deals and funding those deals. I honestly, it's a big question, but I will say quickly, locating good deals, it's knowing your markets and then really drilling down on those markets, getting great relationships in those markets.
Yep.
And then funding those deals. Adam, I mean, you can comment on that, but really, again, it's relationships. Why is somebody going to lend you that money or invest with you?
Exactly. Yeah. And that's, I mean, probably two-pronged there, because I'm not sure if this is directed towards lenders or investors or partners that are going to come along. So the lending market is still strong. Now, I mean, they obviously have hiccups going on with obviously our Fed meeting that's happening, and there's a lot of moving and shaking that goes on when stuff like that happens. But people are still lending, and it's a very up and down market with each and every individual lender. So it's constantly fluid. If you only have relationships with one lender, you could run into a big issue. So, having relationships and talking to multiple lenders will definitely help you over the long haul.
Yep, absolutely. So I think generally, Dale, it's really just time on task, consistency and persistence, and being in the space and who and developing a track record with those people. But Brent,
John, can I add a couple things there real quick?
Please, Robert. Yeah, sorry to jump over you.
Yeah, I was just going to say, I think a couple more points that I would just add to that. One is be authentic. I think a lot of people in our space feel like they can somehow sell their way to success in real estate, and it's pretty challenging to do. There are a lot of savvy lenders, brokers, operators, you name it, that are out there. And there's a lot of good people too. There's a lot of people that are kind of a pain to deal with, but there's a lot of good people. And there's a lot of people that will want to help you. And so if you are transparent, not to the point of making yourself look like a fool. I mean, do your homework, make sure you know what you're talking about. But if you're transparent and say, hey, I'm looking for this and I'm trying to do this, or I'm, this is my goal, there are people out there that will help you. So I would recommend that, first of all. Secondly, I would recommend typically starting with understanding what your skill set is, what you're good at, what you like to do. There are basically 5 components to this business. There's finding a deal, funding a deal, which we just talked about those 2. There's also putting a team together to actually run the deal, whether that's third-party property management or partnering with somebody that knows it. And then there's also a balance sheet and liquidity component. So the partners or you have to have enough of a balance sheet, a net worth and liquidity in order to qualify to get that loan. And that's, sometimes you got to go find a couple of people to help you out with that. So there's different components to this business. And I would just say, think about, what do you have? What are you missing? And then think about finding somebody to potentially partner with to fill in the gap and build a team. And if you've got everything on your own, awesome, more power to you. But typically in this business, it's a business that's built on teamwork. We have a team here, John, Adam, Josh, there's a whole bunch of people behind us. It's a team sport. And I think to do well, you definitely need to think along those lines. So anyway, just wanted to add those couple points.
Glad you did. Thank you. Thank you.
Yes, thank you.
Brent, at what point do you think rents will become too high for tenants to afford? And do you see any markets, Phoenix being an example, already reaching that point? Well, Phoenix isn't there from what I've recently been looking at, and also speaking with operators in Phoenix. They still had rental increases last month and all the way up until the last 2 weeks. But I will say that real estate is hyper local. So what rents are doing in Phoenix versus Fort Wayne, Indiana, very different things, right, Adam?
Slightly.
You can still get a 1-bed apartment in Fort Wayne, Indiana for $300 a month, folks.
Yes.
I don't know about that.
Oh,
Come on.
So, but no, at what point do we think rents will become too high for tenants to afford? I mean, that's a really good question. I think that, price fatigue in general is certainly something to talk about. If that's, in residential resale, if it's new construction, I watched that in Boise happen, where some people just put their hands up and said, you know what, I'm just not going to buy here. And the same thing happened with the rental market. Rents increased so quickly and just didn't really seem to be slowing down for a time, that people decided to go somewhere else. So I think that is a theme there, but I would also argue that rentership in America continues to rise. We have an overall deficit of multifamily housing, and we're in an inflationary environment too. So you have to ask, all of those components and even more than that added together, where does that leave us? So I do believe that rents will continue to rise. They could plateau off. Maybe they even decline sometimes if there's some concessions. But generally speaking, over the long term, again, going back to our original conversation about our business plan, long-term rents continue to rise.
yeah. And I'll add to that, John. Great points. Generally speaking, if your income is 50%, if your rent is 50% of your income, that is considered roughly the upper limit of affordability. Now we have some cities, some areas that are pushing 60, 70%. And that's a big concern, because it's really past what normally we would consider affordable, if you will. So, the ideal, the sort of best place is somewhere in the 30, 35% range. Same thing with the mortgage. Our income limits on our properties, or income targets, I guess I should say, are right at about 30%. So we want to see 3 times the income versus the rent. And we're able to do that in every single area where we're currently located, Southeast, Midwest, and Texas. So my concern, or the red flags would start to go up if I started to see that deteriorate to the point where people are making, half of their income is going to the rent. Then I would start to get more concerned. Right now, we're actually in a very good position because wages are finally going up. Now, the affordability gap is actually widened between renting and owning, such that it makes a lot more sense to rent recently. Whereas I think 6 months ago, it was a little bit closer. It was still cheaper to rent, but now it's much, much cheaper to rent because of the cost of a mortgage. So from a business standpoint, again, a lot of people moving more to the rental market. And then the question is affordability. Well, we're not seeing that there's some drastic affordability issue, at least in the properties that we're doing. Now, again, like I said, it really depends. You go to, I'm going to throw out San Francisco, although I know their rental market is soft quite a bit. But traditionally speaking, San Francisco was very unaffordable, 60, 70% type numbers for the higher end. So I think it's important to remember that, because at the end of the day, if wages are going up, rent is going to go up because the supply and demand is not changing anytime soon. So there's really at this point in time, there is no end in sight to rental increases in America. There just isn't. So.
Great points. Adam, anything to add?
How much money can the government print?
Yeah, well, Adam, that didn't really help us because half of it got stuck in some multi-billion-dollar, like whatever during COVID. So I don't know.
Yeah. No, I'm just kidding. You guys covered it pretty well.
Great. Maureen, you are the only person to have shared your video, which we appreciate. And you did ask a question. Do you just want to ask that live? You're still muted. I think it was particular to how to purchase and structure your investments.
Oh, yeah. So the question that I have is how to project and plan your income versus your programmed write-offs. You've got this situation where you enter a deal and the first year you've got this big loss, right? So you've got a passive loss, and passive losses, I think you can't take them unless you've got passive income.
Correct.
Right. So if you were only living in the world of apartments, then you would want to have some apartment buildings that are giving you passive income to offset the passive losses. And so is there any way to, like, you have a spreadsheet for how to plan that?
We probably do, because we have a lot of spreadsheets, but I can just tell you off the top of my head, on a deal like, for instance, one of the deals we do with the cost segregation study and accelerated depreciation, which, by the way, is set to expire or start phasing out at the end of this year. So the math is going to change a little bit. This is the last year, at least for now. We'll see what happens in November. That may change with the new people coming into Congress. But right now, it is going to start to phase out starting in 2023, where right now you can get 100% bonus depreciation. 2023, it'll be 80, then 60, then 40, it'll phase out. But let's just assume today you purchase a deal, you get accelerated depreciation. For the most part, you're going to get 5 to 7 years of tax-free distributions because of that. So that loss in the first year, second, third, whatever, it's going to offset 5 to 7 years of your distributions coming off of that property. Now, what happens at the end of the 5 to 7 years? Well, the goal would be to take the distributions or the refinance money that you've gotten. If you're living off of the distributions, obviously you're not going to do that. But if you do a refinance, you take that capital out of the first property, reinvest it into the second one. Now you've created a new stream of tax losses. And this is what we do in our properties. And that additional stream of tax losses will then offset the next set of gains plus the first ones. So it's kind of a combination of working the depreciation, but then refinancing the additional equity that you built so that you can then capture additional losses every, call it 5 to 7 years. That's the strategy that we use. And it's about, call it 98% tax efficient at the end of the day. You will pay some taxes, but assuming you can get that refinance, it will give you additional depreciable losses that you can take.
So whatever you can't use, you can carry forward indefinitely?
Correct. Yes. Yeah. And of course, you'll burn it off within, like I said, 5 to 7 years. So there's really, again, like you said, you're assuming you're invested in a property that's profitable, that is kicking off passive income, whether it's distributions or not, it doesn't really matter. But the point is, it's kicking off profit. And so that's where you want to use those losses to offset it. And you're exactly right. So if you're just in the world of multifamily, you've got 5 to 7 years. Some people, of course, they'll invest and they'll take the entire loss from that initial investment and apply it to other passive income, which they could do too.
Mhm.
But that's down the road. I think, if you kind of look at your net worth and you're maybe 10, 15 years down the road, you may get to the point where you need to put some additional capital in to continue offsetting that passive income. But that's, again, that's 10, 15 years down the road. So again, if somebody's living off of their passive income and they're done, they're not going to put any more money in. It's a little bit different equation. But if you're keeping that money rotating and working for you, you can keep those passive losses going for a very long time.
Sound good, Maureen? Clear
Yeah,
as mud.
I think it really requires an awful lot of detailed calculations to try and figure out how to make that work exactly right. But see,
Yeah, well, and that's where
what you want sometimes is other sources of passive income besides the apartment buildings. And if you really wanted to have passive income, so that you could take advantage, let's say that you wanted to have more income in cash, and are there other investments out there that throw off passive income that are not apartment buildings that you can match them up with?
absolutely. Yeah, I mean, you can.
That has cash flow, it has cash flow.
Sure. Yeah. I mean, there are other things out there that will generate cash flow that you can offset, passive income that you can offset with those losses. I would say in general, most of those are going to be a little bit riskier. So, again, that's the caveat to that. I think multifamily is probably going to be your lowest risk cash flow return from that perspective. But there are other things out there where you can get passive income. I know these, what are they, like the mineral rights, the large partnership, oil and gas and all that stuff. I don't know too many people that make a lot of money off of that, but I know there's some that do, and they get their income. And so again, they would be able to potentially offset that if it's set up in a partnership structure. If it's set up as a corporation and they're getting a dividend, that's different. You can't offset it. But if it's set up as a partnership and you're getting income from that, you could offset it. And remember too, that your distributions are, and I know we're getting into the weeds here a little bit, but your distributions are different than your income.
Right.
So, distributions are what you get, income is what you pay tax on, two different things. So anyway.
Oliver offered Maureen to self-storage as an option as well.
Yeah.
Oh, really?
Yeah.
Yep. Parking lots,
Absolutely.
mobile home parks, office space. Of course, that's all real estate related, but yes. Yeah.
Got it. Yeah, so because I can see where you could be way out of balance from time to time.
Yes. Right. Yep.
Absolutely.
Yep.
Anybody want to come off mute and ask another question?
Everybody's good.
I would ask one.
Hey, Oliver.
Hey, so assume you finance a property at a 70% LTV, and then the market situation deteriorates and the market declines, the property value declines, and now you have a virtual LTV of 80 or 85%, which may trigger some threshold at your lender. Is there a chance that your lender could come back to you and say, you know what, I'm sorry, under current market conditions, your LTV is way too high. We expect you to make a large payment to get the LTV back down?
Robert, before you
Absolutely.
answer, let's break this down for the newer folks, because Oliver is a repeat investor of ours, and he's very astute and experienced. And so some people might not totally understand and follow LTV, et cetera. So if we break that down before we dive into it.
I'll let you do that, John. Go for
Okay.
it.
So what he's talking about is simply loan to value ratio. So when you're getting financing, how much is equity? How much is your debt on the property? And then what is the value of that property? And he's asking about, well, if there's a shift in the economy and property values change, what is that going to do to your ratio for loan to value? And could they potentially come back and I don't know, what would we call that? A lender capital call?
Call the loan. Yep.
Yeah,
Mhm.
calling the loan. Sure. So Go ahead.
Yeah, well, exactly. That's pretty much the question. If the economy crashes and valuations go down, is there a possibility that the lender could come back and say, hey, you know what? The value of this property is no good anymore. I want my loan paid back. Or I want you to put some money into the deal, which was actually what Oliver was asking. And I would say, absolutely, there's always a chance that that can happen. That's one of the reasons that I think it's so important to be well capitalized in real estate if you're serious about not losing money. Because if you buy a good asset, in other words, a good business, again, going back to what we were talking about at the beginning, an operationally sound business that's profitable, then you will want to hang on to that. You will not want to sell it. And so if the lender comes back to you and says, hey, we need you to put $1 million in, you need to be prepared to do that in a worst case scenario. And that is one of the things that we are prepared to do if we have to. And that's why I think it's so important to be well capitalized in real estate, because if you're really serious about being in it for the long term, you're going to have ups and downs. And I think the chance of a lender doing that is very small, even in a bad scenario, but it can happen. And I think it's important to be prepared. So yes, that's a good question, Oliver. I'm with you on that.
So do you think, is that rather a theoretical
Yes.
case only, or do you think that the lender could actually do it?
Well, I think that there are a lot of factors that would play into that. So we would have to see a scenario where rental growth was flat or declining. We would have to see, I think, a scenario where our net operating income was declining, so that the value of the property in the market was truly decreasing. And then it would have to go below a certain threshold where the lender would be essentially feeling that it wasn't worth their effort to continue with the loan. So they would, again, they would essentially be saying, we are going to take this property back or potentially take it back, which they really don't want to do unless they're in a really bad situation or they need liquidity or something like that, which happens. But generally speaking, that there's a small chance that that happens. And again, especially if you as a borrower or you as a operator are reasonably competent at what you're doing and the entire world is falling apart, they're going to focus on the operators that don't know what they're doing. And it's kind of the 80-20 rule. That's where their focus is going to be. And they're going to say, okay, you guys are reasonably capitalized. You're probably going to make it through. Keep on. We're going to focus on the bigger fish, the bigger issues that we have in our portfolio. At least that's been my experience over the last 20 years in the business.
Great, thank you.
Excellent.
You bet.
Who else has a question as we're wrapping up, getting to the end of the hour? Mike Fazio, you don't have any more questions? I answered them all.
I was just gonna say, John, you were so great. I got nothing. I got all your answers right here, so I'm good.
Very good.
I really appreciated your time.
Awesome. Thank you. Thank you.
I'm impressed. Nobody had any questions about crypto. I mean, that seems to come up everywhere.
Hey, John, this is Zach speaking. I do have the Zach with a C.
Zach with a C. Come on now. Let's do it.
So I'm an investor with you all in multiple different properties. One of the functions of the business plan is the refinance, right? And is the remodel and increase the rent. So there's not a perfect answer here, but what does that look like in terms of perspective, right? The business model is shifting a little bit in front of our eyes with the interest rates and also cost of inputs. Just wondering how you guys think about that short and long term from an investor's perspective.
Great question, Zach.
Good question. Thanks for jumping on, Zach, by the way. So I think there's a lot of twos in this business. Well, there's two sides to everything, right? So on the existing deals where we projected a supplemental loan, let's say, where we purchased the property, we got a fixed interest rate at, let's say, 3%. And 3 to 5 years down the road, we want to add to that. We built in equity of the property. We don't want to sell the property. We want to do some sort of a supplemental loan. It's almost like a HELOC for a multifamily property. So those scenarios right now have become more challenging because the interest rates have gone up more than we expected. We always expect they're going to, we plan for some increase, but the interest rates right now have gone up more than we expected. So we're sitting in a scenario where the lenders are less likely to lend, the leverage is a little bit lower, the rates are a little bit higher. And so we're kind of in a situation where, do we really want to add more debt right now to a good property that's performing well, with the expectation that probably within a year, plus or minus, I guess we could debate that, we're probably going to be back at a much better position than we are today. Now, if you think interest rates are going to 10% over the next 2 years, and then everything's going to break loose, then obviously you're going to disagree with my philosophy here. I think by the end of the year, the Fed will have completed their interest rate hike. And I think 2023, we're going to see rates start to come back down. So the question in my mind is it worth waiting to fully execute on that business plan? And or maybe we don't refinance, maybe we sell the property and capitalize on the equity we do have in that and roll it into a new deal that we're getting at a 15% discount today with some nice cash flow. So that's scenario number one. Scenario two is a new deal that we're picking up today. We have the business plan that we want to refinance in 3 years. Well, the difference today is that we don't want to lock in 7 years at 6%. I don't think that's the right strategy today. So that means we're using shorter term debt, which means that when that 3 to 5 year window does come around with these new deals, it will be easy to refinance because we won't have the question of trying to do a supplemental loan. And so in some ways, we're actually getting better flexibility on the new deals currently than we had on the ones that we did in the past. So there's always a silver lining. There's always a give and take in this business. Unfortunately, there's no sort of, you get everything, eat your, what's the phrase? I can't even think about it. Get your cake and eat it too, or whatever.
Or pie.
Anyway.
Whatever.
Yeah. Anyway. So I feel like it's a little more nuanced than that. In that the deals that we had on the books currently, they've got a lot of equity in them, but do we want to go out and borrow at 6.5% for 5 to 7 years out? I don't really know that that's the best decision right now. Now, if they weren't cash flowing, it might be more challenging, but when you're talking about these deals that are kicking off 8, 9, 10, 11, 12%, that's a pretty good return in and of itself, especially in an environment where we're at today. So there's a little bit of math that goes into that, but I would say overall there's positives to both from a deal perspective. So I don't know, does that kind of answer your question, Zach, or was there more to it?
No, I think that adds perspective. My second part of that, a little two-parter, you can't just have one question. On the on the remodel side, are you guys staying in positions more of holding on to cash, slowing down the remodels on some of these, or continuing on with the business plan there, given the cost of inputs coming back down a little bit?
Right. Yeah. So I would say it's pretty much the same. The cost of doing the renovation has gone up, but the upside has also gone up where, 2 years ago, maybe the upside was $150, $200 of rent upside. Now it's $300 or $350. So from a return on investment standpoint, the numbers are still looking quite strong. So I would say that we are continuing. I don't know that we've accelerated or decelerated. We're continuing. And really the only thing that I'm watching is if something changes, then we might want to step back and take a pause. And the only reason we might want to do that again is just to say, all right, let's make sure that the math is still good. But throughout the last, through the pandemic, through everything that we've seen currently, those numbers are still strong. So I look at it and I say, hey, if we're going to go out there and we can invest $1 and get 3 to 4 in return, I'm all in. Let's do it. So that's kind of our philosophy. But like I said, if something changed and we felt like that wasn't going to be true, invest $1, get $1, then all of a sudden the math changes, the business plan changes. So, but yeah, to answer your question, so far we're continuing to push forward. And actually, the biggest challenge that we have today is finding enough people to renovate and turn these units. I mean, that is our biggest problem. We have plenty of people ready to move in, pay the rent, and keep the rent going up. So the biggest thing for us is finding qualified people to do the renovations across the portfolio. So if you know of anybody, please send them our way.
We've actually talked about having Adam kind of put on his tool belt.
Yeah, that's right. Want to see that?
I have a quick question.
Okay, go ahead, Maureen.
Yes.
Said that the tax law is changing and it ends in 2023. Are you still going to be
It's-
able to take the bonus that, the accelerated depreciation in 2023, or is 2022 the last year to do that?
So 22 is the last year of 100%. 2023 will be 80% of that accelerated depreciation.
Of new.
Now,
Of new. I think Maureen was kind of talking about anything that she has left over.
No, I was thinking about, what I was thinking about is,
Apologies.
would we be better off investing money this year and banking more future losses at at a rate of 100% than
Yep.
waiting till 2023 and only banking 80%? You're eventually going to get to write it all off anyway, right?
if you wait 27 and a half years, yes.
Okay, I think I understand. Oh, because it's 30 years.
Well, it's 27. So the most of the depreciation is
Residential.
based on 27 and a half years.
Oh,
Yes, if you wait 27 and a half years, you will get the entire thing, which
Oh.
practically speaking is not going to happen, right? So yes,
Oh.
the accelerated depreciation is a big deal, and you
You're
absolutely
kidding.
want to invest this year, unless come November, we get some people in Congress that decide they want to extend it for another, 5 years, which could happen, and I'm hopeful that it does happen. But as we stand today, this is the year to get that maximum benefit.
Yeah, but
I-
this, I didn't quite get that this was one of those other quirky things from 2018's tax law. I mean,
Okay.
this is outrageous, quite frankly, even though we have the great opportunity to take advantage of it.
Sure.
Yeah,
I think that it goes down by 20% each year
correct.
to 2026, Maureen.
Right.
So
Right.
it'll go to 80, then 60, et cetera.
Okay. Wow, that's like a whole new factor to think about, because,
It just blew your mind. You already had issues, Maureen, and now you got bigger ones.
oh, yeah. Okay. That's unbelievable. We had that happen with a freezer in 2018. We got to write the whole thing off. But just imagine you could write off a whole hotel
Yep.
like that.
Correct. Now remember, just to put a little bit perspective in that 100% accelerated depreciation only applies to property or things in the building that have a 15-year life or less, according to the IRS.
Okay,
So generally speaking,
it's not a building
70
itself.
yeah,
Right.
70% of your building is still going to be a 27.5-year life.
Oh, okay.
But that 30% that you can take all of that depreciation is still a big number when you're talking about a $60 million deal or whatever it is, So it's still a big number, but it's not 100% of the entire purchase price.
So it's like 30% of the purchase price, you think?
Usually the deals that we're doing, it's 25 to 35% that is able to be accelerated on the first year.
Oh,
Correct.
okay.
Yeah.
I was thinking you got to write off the whole thing, but no.
Oh,
Yeah, it's not quite that good.
that'd be crazy.
Well, it would be crazy. But that's what happened with the freezer, which is really what it was, because it was a freezer that was in a building, and and it was because we put it in place Q4 of 18. We wrote the whole
Correct.
thing off, and it, my taxes were hardly anything.
Yes, absolutely. Yep.
That's
Okay.
a big freezer, Maureen.
Part-
I said that's a big freezer. Okay. So we are 10 after, folks. We really appreciate it. If there's any more questions, feel free to reach out to us individually. We always try to be as accessible as possible, and we'll keep doing these once a month. I think they're a lot of fun, and we got some great conversation. Just as a reminder, we do have the Avenue 33 property, a little bit more room left in that, and we have our Marbach property in San Antonio. So that's if you have some investable funds, please take a good look at that. And thank you very much. Appreciate you taking some time to be here tonight.
Yes.
Thank you, guys. Have a great evening.
Thanks, guys. Take care.
Take care.
Thanks.